Welcome back to the Discovering Commercial Real Estate podcast. We're privileged to have the founder and CEO of Astor Realty Capital, Joe Berko, here with us today. Joe, it's a pleasure having you on. Thank you again for doing this.
Thank you for having me. Good to be here.
Of course. So, Joe, before we get into business, everyone wants to know what's happening with the market. You've been in the business for 27 years. Could you kind of give us your perspective on the market and what are you seeing now that you've never seen before?
First of all, great question. Every cycle has its own dynamics. There are no two exact cycles. It's always different. And in this particular case, what we're seeing is complete another attack, I would even say, by the feds in order to reduce values in every sector, not just real estate, but certainly real estate sector is taking a hit like all the other sectors as well. And we're seeing it because there's a direct correlation between rise of interest rates and valuations. And so, if we're looking in hindsight, we have the top of the market is March 2022. It's been a good 14 months more since the top of the market. And it's been a very steady decline in valuation. In fact, if you look across all sectors of real estate for the last 14, 15 months, we're looking at about a drop of about 15.2 to 15.5% on all sector. Now, of course, it gives you an indication of what's happening with the market, but doesn't quite give you a clear picture. So we want to zoom in a little bit more, okay? Go inner from the macro of all real estate sectors. Surprisingly enough, the real estate sector that is the most resilient has been dropping for about 19%. Multifamily has taken a dive, 19% dive, which is quite a thing, and what it means to our viewers. If before you would underwrite a Class B in a semi, maybe a tertiary market at around a 5 cap, if you can find those, right? There's quite a period of time where everyone was buying 4 caps and even sub 4s. But if you can find a 5 cap, today those 5 caps are underwriting at a 6. So we're talking about nearly a 20% drop. And of course, different markets, if you look at Miami, it's a different conversations, but every market has taken a hit. Cost of capital determines essentially how much people will pay for assets. And so, you got to paint a broad brush, get a good understanding of where things are. And where things are is when we've seen a drop. The second indicators are in our world is cost of labor and cost of goods. So cost of labor have become extremely expensive. We're all looking at shortages. Individuals not coming back to work, and if they're coming back to work, it's in different formats. So to get the GCs back to the business and to get them back on the field to do the work, it's gotten to a very challenging environment. So cost of labor has gone up, and that affected our ability to build. So in one way, we have cost of capital that's expensive, cost of labor that's expensive, and of course inflation. Right, where we're looking into hovering inflation of somewhere between 8.5% and some months I would even argue 9%, and that is essentially have taken a big toll on how much we pay for goods that we purchase for the development and projects that we're essentially investing in. And so this is kind of like a perfect situation, a trifecta of a disaster. And so what we've done for the last 14 months is we're actually taking a chill pill.
Okay.
We're seeing the markets coming down. We go over 800 transactions a year. We get 800 transactions. And 800 times our analyst has to open up a file where somebody's asking us to participate. So somebody's asking us to come in and do a joint venture with them, come in and lend money, whichever the situation may be. And we're like, this is really not the right time. We're just going to be observing. We're going to be in communication with everyone, but we've been very, very blunt. We're going to be sitting on the sideline. And it takes a certain amount of discipline. Different conversation for a different date, but it takes a certain amount of discipline. So we do have to keep the lights on. We have salaries. I'm not in the habit of letting people go when the market contracts. Just not how I am. Good evidence of that. Most of our associates have been with us well over 10 years. And so I believe in keeping that talent and actually keeping it very, very close to us. So we were sitting there. We're in discussions. Where our pulse is on our fingers on the pulse at all times, but we didn't dive in. I'm looking at the bottom of the market, and that's something that's very contrary to what you'll read in the news and the
Right. Yeah.
headlines. It's very, very different. Everyone's recession's coming, and the second shoe is about to drop. I've seen about 6 cycles, like you said. I'm 27, actually 28 years in the business, close to 30 years in the business. I started from 1995, coming out of a very lengthy, very, very lengthy recession. It started actually in the late 80s. And so, yeah, I've seen the cycles. I know the conversation. I know the pain. I know the fear. But I'm also looking at all the other stuff. Now, newspapers and everyone, and they need to sell and they need to be sensational. A newspaper, an outlet, any media outlet sells when there's something negative
Mm.
to sell, right?
Of course.
Something has to be sensational. And so I believe that there's a lot more fear. And I believe that, in our reality, we're starting to see all the fundamentals. So if you're sort of like starting to take a look, not what, the naysayers or the analysts are saying, but actually look at what makes an impact for your business, and in our case, commercial real estate industry, then I believe then you start to see that the sun is starting to pick from the
Mm.
clouds.
Mm.
And I believe we're looking at the bottom. Now, is it possible that we'll see a little bit more of a drop? Is it possible it's going to continue a little bit longer? Nobody knows where the exact bottom is. But from our standpoint, we're now back into the market. So we made a number of offers. Today I signed my first transaction over 14 months. We're negotiating a larger one, pretty much a larger transaction. And yet we've shifted a little bit, taking into account that a few things are different, right? There's a lot less capital today that's available to jump back in, which
Mm.
is the space we love. Less competition, right? You can pick and choose better. And so we're able to, drive our negotiation points, not just to achieve a higher yield, which we are, but also to mitigate our risk better. I'll give you an example. Previously, about 50, 60% of our portfolio has been focused on common equity. Right now, most of our conversations are on preferred.
Mm.
So the discussion of preferred is a little different.
Right.
My money at first, my coupon is attached to it. I still have the same control rights. I still have the same takeover rights. I still have the same, major decision rights. Nothing changes. However, my position is different. And so in our business, we choose markets that we want to operate. We choose the asset class we want to be based on, number of fundamentals that's important to us. And then we decide how we want to enter, right? We have 3 strategies. Strategy number 1 is common equity. We'll do a lot of common equity. We have, as a collective, if you look at our portfolio, it's about 3.6 million square feet across 7 states. Important to diversify. Geographical diversification is important. So 7 states, 12 cities, major cities, 12 of the top 25 MSAs in the United States. And we choose those markets for various reasons. So for example, we mitigate risk by choosing diversification of location, but
Mm.
also diversification of asset
Mm.
class. In Phoenix, we've been watching Phoenix, and it's a market that we love. Phoenix have shown a very high trajectory and a big pipeline, huge pipeline of multifamily coming in. So there's Austin and other locations. And we sort of like starting to see that there's going to be some sort of a bottleneck situation there, a little bit of a disequilibrium between supply and demand.
Right.
So that's something that we want to watch out for. And so we're not going to dive into Phoenix as much as we love it on the multifamily space. However, we're building a 265 key hotel, a 5-star hotel, probably in one of the best spots
Mm.
in Phoenix. In fact, it's Scarsdale, the Caesar Republic, the first non-gaming Caesar. That's going to be a lot of fun. So choose the location, choose the asset, and diversify. Create whatever you need to create in order to reduce risk. Why? Because we can. Because there's less capital available today. And we're certainly back in the market early enough to catch kind of like the better opportunities.
Got it. Okay, understood. And let's get into you. Walk us through your journey in
Mhm.
commercial real estate and how you kind of got started.
Okay, now let's go back down memory lane. We're talking now almost 30 years back. I'm an immigrant, and when I got off the boat, so to speak, I started doing all kinds of odd jobs. I didn't have a lot of money in my pocket. It was me and a bunch of friends living together. Early 20s, doing all sorts of odd jobs, moving company, working as dishwashers, and do whatever we can in order to kind of like keep the rent going and have enough money to go outside at night, go to the clubs, and
Right.
have a great time. Um, and then I picked up this ad that said shower, real estate shower. I was like, what's a real estate shower? Sounds interesting. So I called it up and got into the interview. It was, here's the keys, take them to the apartment, say nothing, bring them back. You're not allowed to talk to the clients. It's a
Okay.
real estate shower. That's before you get licensed. And it was first time I was, putting my shirt, tucking my shirt, uh, you know, dressing up, button down. I felt nice, and I really liked the environment.
Uh-huh.
So I've done that, and after a course of several months, maybe, I kind of like realized that this is something that I like to learn more about. I'm actually very interested. At the same time, local community college over here in New York City started a new program called Real Estate Metropolitan Development. I
Mm,
just loved it. I was like, I'm down. So I signed up and got myself a 4-year degree that's finance and everything that has to do with real estate and zoning and real estate law, and it was quite fascinating to me. When I graduated, um, it was right, unfortunately, right after 9/11, so the city was shell shocked.
mhm.
I went back to what I knew at the time, which was again the world of brokerage,
Mhm.
and thank you, the world of brokerage. And so only at this time it was commercial real estate brokerage and commercial real estate finance. And so we were focusing on financing buildings. At the time, interest rate was kind of like normal 6.5, 7, 7.25. That was the way of the land. Um, and then slowly, interest rates started coming down. The market was starting to move a little bit better.
Mm,
Things were getting better. The 5% environment, the real estate environment was coming in. I've learned a lot during those years, financing properties throughout New York City, large office buildings, small apartment buildings, you name it, anything commercial. We didn't touch anything residential. And then I had an opportunity with one of my clients to sell a property. And I
mm.
remember the conversation. He's like, decided not to finance. I decided to sell my asset. It was, I think, a 12 unit apartment building in Upper Manhattan. And so it's listed as property, started with the sale and financing. People showed up. I was able to talk to them about financing. Bids were coming in, and I realized, I mean, that's a great kind of like a way to
Right.
add to your business. Like in McDonald's, do you want fries with that, right? So here I am selling the property. Can I help you with financing? I can arrange for you debt. I can put it together. And I was essentially, about a year after I left that shop and started my own shop, Berko and Associates, we were the first office that would offer both services. It was kind of
Mm,
like unknown. If you
mm.
were in investment sales, you were in investment sales. If you were in finance, you're in finance, and that's it. There was a
Right.
firewall between the two. I did notice, however, and that's a comment on the industry as a whole, but I did notice that the folks that were focusing on finance, the agents, the brokers that were focusing on finance were a lot more sophisticated,
Mm,
understood the asset a lot deeper, and had a much better vision and understanding of how things work.
mm.
Just because they didn't just pitch the deal and what is, but also were able to
Right.
finalize and analyze how the property goes. So that was my starting. That's how I started. Company quickly grew. It was around 2005 at that point. Very good years for real estate. Very good years for the economy in general.
Mm,
I've done a good amount of transactions. Probably sold, financed, closed, arranged, raised capital well over
mm.
$3 billion over the course of about 18 to 20 years. The top of my career was around 2014. Now, over those years, I would also invest in buildings myself. I would also buy properties. And in 2014, I sort of like pivoted.
Mm.
Um, and I like to tell this story by actually the day after the biggest closing of my career.
Mm.
So here I was walking down from my office on Fifth Avenue with a seven-figure check in my hand and walking towards the bank. The night before, I closed a $182 million deal. It
Mm.
was the biggest deal of my career at the time, right? And, I've done that walk before, and it was a happy walk, right? You kind of like, you're skipping your
Step.
in your step, and you just, you're sort of like, singing and laughing all the way to the branch. And this time was different. This time I was tired, I was frustrated, I
Mm.
was spent, and quite frankly, I was pretty much done.
Mm.
Um, this transaction, I think, took a big toll on me, right? It was an office building, large scale office building around 7th Avenue. And everybody in the market wanted this property.
Mm.
Nobody could deal with the seller. The seller was extremely tough, would flip flop around on the price. You give him his price, he wants more. You give him the more, and now he wants to change terms. It was just impossible. And close to $200 million deal. Who wants to deal with
Yeah.
something like that, right? So nobody took him seriously, but I did. I used to say I specialize in the difficult cases. In fact, my saying was I specialize in crazy. and so and so here I was. There was a buyer wanted to convert the building to a really trendy hotel, which he did eventually. And we negotiated the price, and then we negotiated the terms. It took months and months and months of negotiations, and lots of emotions. But eventually, I got them both to the closing table, and
Mm.
then we've closed. Um, Over that period of time, I've been noticing my industry changes, right? Changing over time. If you look at Silicon Valley, billions of dollars are being spent in order to, disrupt our
Mm.
industry. If you look at the way, New York City commercial real estate brokerage it was like offices being open left and right. Competition became insane. We
Mm.
always looked for areas where there's less competition, right? For a while, I focused on hotels because nobody could underwrite hotels.
Mm.
So many moving parts,
Mm.
right? It's probably the most complex piece of real estate to underwrite,
Yeah.
hotels. So I was focused on different things because I was looking for areas where there's less competition. I didn't have the type of budget that a lot of the national firms had, right? For marketing and for reach out and for all that good stuff, which comes with a lot of ego and things like this in this market. So here I am in the most competitive market, and we were doing good, but I've been noticing how things have been different. Also, information has been filtrated, right? So information that used to be proprietary, almost proprietary to brokers, now became available.
To
Became
everyone.
available to everybody.
Mm.
2 clicks of a mouse. 1-year analyst got the same information. Information was flowing so quickly. The value perception that brokers brought to the table was diminished, and with it was also the commission splits.
Mm.
And I also think the respect that the industry have for commercial real estate brokers and brokers in general. I argue today that people have access to everything, but understand the value of almost nothing.
Mm.
And so after that deal, and it was nice and warm and fuzzy. I got nominated for awards, and CoStar now gave me an award for New York City Power Broker, and Globe Street gave me an award, and presentation. It was in the newspaper. Everything was nice and warm and fuzzy, all the great stuff. But I wanted to sort of like shift. I started slowly move away from that environment
Mm.
into something different. So I've taken a short break. At the time, I had 25 different associates in my office. I was coming to the office, but my focus was really more observation of what's happening truly
Mm.
with my industry. I wasn't running, like a mouse on a wheel. I was really observing what's happening with my agents, what's happening with the other ploys, other offices. And so, from that point of frustration, which I think is extremely important, my private equity was spawned,
Mm.
right? The private equity was
Right.
spawned. And it came from a place of, look, where's my value add? Okay, where's my value add? What's the perception of my value add for me? What's the perception of the market of me, the value add? For years, I was known as the sharpshooter.
Mm.
And I was known as the sharpshooter because, as opposed to most brokerage firms who take an assignment and blast it out to the world, I knew probably 70, 80% of all buyers, sellers in the market.
Mm.
And so when I would take an assignment, I would put on a short list, chop it in half, and that short list, I will pick out the most aggressive buyers,
Right.
put that very, very concise list, and then go and meet with each and every one and speak to them about the asset. The end result was the market would hear about those transactions a month or two after they would actually happen when they close.
Right.
And so it was a different approach. And so over time, if partners were have issues and they didn't want the world to know about it, that they're selling, or one guy needed to sell and the other partner wanted to stay, all kind of different situations were a lot more difficult, I will be the guy that they would call.
Mm.
And so, so that's one area that we brought a good amount of value. The other value everybody's looking for, what I don't care if you're, if you're Blackstone or if you're, if you're the guy from the corner with a small apartment building, everybody's looking for equity.
Mm.
Everybody needs equity. The bank situations, there's a relationship, they're out there, they're known. But equity is much, much tougher to obtain. And so, so equity is always in demand. That's one nugget of gold.
Right.
The second nugget of gold is what makes me happy, right? And what makes me happy, am I fulfilled when I am making a transaction to somebody who's ultra already and I'm making him even extra? Or am I more fulfilled when I have individuals investing and actually seeing returns and where the impact is? And so I started observation about what makes me happy, what's my value add. And so I spawned a whole different company called Astor Realty Capital, private equity.
Awesome. Great. And how would you say that the skill set of being a broker and the skill set of being an investment manager are kind of similar?
Well, there's obviously tons of similarities. You would think that because we walk around and we have money with us, because we're institutionally backed by public companies from overseas and other companies here as well. But you would think that if you walk around with check, then that's that. The reality is, for a good deal, there's always money out
Right.
there. And so the relationship is extremely important. It's really important for me, and it's important for the other side as well. And those relationships are what you need to spawn and what you need to create when you're a broker, right? Because people do business with people that they like,
Yeah.
right? So that's extremely, extremely important. The persistence is an important thing. As we discussed earlier, I left New York right before the pandemic. My wife and I moved down to Miami, and it's a very different market, right? The speed is very different. A New York minute and anywhere else United States minute, it's a very different
Fast-paced.
conversation. And so, being persistent, it's a New York trait. I'm also Israeli, so that's a double combo, right? New Yorker and an Israeli. So being persistent is extremely important. Being determined, it's a very important trait. Works for broker and also works in everything that you do. So you can find a lot of similarities. And I can probably come up with more, but I think those are the major ones.
Got it. Understood. And who was your first mentor in the business?
My first mentor. I don't know if he's my first, but certainly early on, I would listen a lot to Ethan Penner. So Ethan is, it's a really kind of like full gamut, super interesting character. In fact, I always tell him the same thing. Ethan, if Dos Equis ever drop this guy, that's the most interesting man in the world, I'm immediately recommending you. Ethan Penner is known for, putting together the CMBS market in his 30s, right? So he was running the desk of Nomura, a fascinating guy, a true fascinating guy. And in his early 30s, come up with this concept, if it works for residential, why not do it for commercial?
Right.
And so he started bundling together real estate, commercial real estate loans and selling them off, right? And that spawned a whole different industry. So he was credited with a lot of that. He's a super smart guy, very intuitive. And what strikes me about him the most is, how you're about to talk to somebody and you're about to ask a question, and you kind of like almost in your head know what sort of an answer they'll give you. I can never figure him out. I never figure him out. He's got an angle that I think is extremely different than most folks that I know. So I love this guy. He's certainly one of the most important mentors that I have. Um, right now, my mentor, I would say, other than Ethan, is Adam Coffey.
Mm,
Adam Coffey is this phenomenal guy. Was where is under Jack Welch of the great Jack Welch
right.
of GE for many years. Picked up a lot, then went into the world of private equity, not real estate, but all industries together. Bought and sold over 58 companies. Been a CEO. He's called a CEO whisperer. He's been the CEO of major companies. Have a couple of $2 billion exits. Working on the third. 2 New York Times bestsellers. Working on the third book. Have amazing life experience. Was in the army. Actually, was a helicopter pilot in the army. Fascinating guy. I'm lucky to call him a friend. I'm lucky to consult with him. In fact, he's on our board.
Okay.
Um, just a wonderful of an individual. Another one that I think made an impact on me, not on a personal level, but certainly made an impact on
Mm,
me, is Sam Zell.
okay. Yeah.
So Sam Zell, for me, is the most eccentric. I mean, the late Sam Zell,
Yeah.
God bless his
Rest in peace.
soul, recently passed. I think he's the GOAT. I think he's the absolute GOAT. It's the greatest of all times. Here you have a guy that in genes runs an empire that doesn't see an end,
Right.
right? You know, balls of brass, extremely sharp, manages risk, and he likes to, so I had the pleasure of speaking to Sam and interviewing Sam. We have this recorded interview and a course that I've done. I'll share later. For 1 hour, we
Mm,
sat, Sam and I, in the middle of the pandemic. I was in Tulum. I was lucky enough to be in Tulum, so out of this really gorgeous villa that my friend built. And I was interviewing him, and we were going back and forth to get comfortable and to get ready for the interview. I read his book, Are You Being Too Subtle?
right.
Are you being too subtle? Back to back twice. I've enjoyed it, and it's just
Amazing book.
nuggets of gold.
Yeah.
It's an absolute must read. Um, and so I was preparing for this interview. Now, Sam, the way he looks at the world, the way he transacts, how he negotiates, how he manages risk, it's who I am aspiring to be.
Mm,
Not by the sheer size. Sam did the largest real estate transactions of all time,
right.
$39 billion transaction. In the history of real estate,
Right.
let me rephrase it. In the history of private equity, there's never been a larger real estate transaction. And he did it the eve of the greatest recession in the last 100 years.
Right.
Sells it to Blackstone in late 2007. And he keeps on saying, I didn't time the market. I know he didn't. I believe him. But I also believe he's so intuitive that he knew when to say enough is enough, take the money and
Right.
move on.
Yeah.
So yeah, so those three are certainly my mentors in the business and in life.
Got it. I want to ask about that deal you put together, the $182 million deal. I would imagine that there are a lot of personalities involved. What are some of your strategies that you employ to kind of nudge people in the right direction?
Mm. I used to say there's no language to sell $182 million.
Right.
There's no language for it. You cannot convince your way through, to this type of a transaction or any transaction. Folks are smart enough. When they want something, when they want it, they'll go for it. Okay. Your job, and this is a quote from somebody that I have a lot of respect for, Bob Nacko.
Mm.
Your job as a broker is to remove the emotions out of the deal.
Mm.
And that's a lot of the work that you do. Now, obviously, you want to bring the facts, right? And I used to tell my associates, don't just tell me about the facts. Tell me about the why, right? Tell me about why you're calling me. Oh, it's a great building. It's got 200 units. It's located in such and such address. And the lobby entrance looks amazing.
Right.
Okay, great. Those are the facts. But why are you calling me? Where's my, right? So you got to go into the analysis. And the analysis of this deal made financial sense.
Mm.
It didn't make sense for the owner to keep it. Like Sam Zell always said, the day you decide not to sell an asset, you essentially bought it, right? So it didn't make sense for the seller to keep it, not for that price point. Yeah. He wouldn't be buying this building again for $182 million. So he should be a very happy seller. And the seller understood it, and I explained it in so many ways. The seller got it. On the side of the buyer had a repurposing of the asset into something that became fantastic, right? Something really amazing, or a 450 key hotel. And so, where would you find such sheer size real estate to be converted, almost perfectly converted, aligned with what you're looking for? And so it was a win-win. And sometimes I don't like this sentence, but sometimes people say it's a win, it's a lose-lose. Or you
Mm,
should do the deal because it's a lose-lose.
mm,
He's giving up the building and you're giving up so many dollars. I don't like that. I feel it's a win-win. I feel that the seller that walked away with a large check, super happy,
mm,
and I hope he did really well with the money. I know that the buyer eventually converted the property and made
right.
it into a very successful hotel. And so, if you present the facts, right, present the why, and the why is, financials and all and so on, right? And if you can analyze it and be good about what you're doing, then people will show up to the table. They'll get interested.
Got it.
Your job at that stance is just to manage the emotions.
Mm, got it. Okay. Understood. And from the principal side, what to you makes a good investment? What are the ingredients of that?
What makes a good investment? Well, it depends on what your philosophy of investment is. Our philosophy in investment is get in, get out, do it in less than 4 years.
Okay.
Apex, the returns, annualized, right? Do it quick. Return the investment back to your investors, and hopefully they'll come back
Mm,
and redeploy capital with you again. So that's for me a good investment. Now, how do I do it? How do I move from point A to point B? I mean, obviously, there's plenty of many roads,
right.
right? We start on a business plan. And I think the most important for me is to ask the question, well, what if?
Mm,
So if I don't have the answer to what if, the worst would happen. A pandemic would happen, right? Economies crash. That is very good chance that during the tenure where you hold the asset, something will
something would
happen.
happen. Yeah.
External, something might happen, right? And you always have to ask yourself question number two. I'm converting a building to condominium. What if the market drops?
Mm,
That's a market dead. What do I do? Can I have a plan B? Can I convert it? Can I keep the building and rent it out? Can I stay above water? Can I make debt service payments? Can I keep my capital? It's all about preservation of capital for me
mm,
first,
mm,
right? That's our cornerstone. And if the answer is no, well, we drop the deal, right? I'm never binary. I'm never like it's going to be great or we might lose everything.
mm,
That's not a good real estate deal. So I think having a second plan, right? Having a second plan and taking into account that things might change, right? Underwrite conservatively, and if the deal still makes sense and gives a good returns, it'll be great. And
mm.
if you catch the headwinds and you actually sell it where the market is in your favor, you did great. Your investors would love you. You made more than what you initially projected.
Awesome. Great.
Yeah.
And what's the most exciting asset type or deal type for you to work on?
Every time I work on a deal, that's the most exciting deal.
Okay.
It really is. um, I love the dynamic of the deal, and it's not just about the real estate. You see, I call it the triple C. A triple C for me when I decide to pursue a deal or not is, we all look at the collateral, right? First C, the collateral. What do we have, right? What do we have over there? Do I understand the real estate? Do
Mm,
I want the real estate? Is that going to be the kind of real estate I want to own and I want to improve or build? How's the market? All those different things. The second C is essentially the credit. Can we actually get financing? Can we raise capital for this deal? Our investors are going to get interested in this deal. Are we going to get bank financing? And if so, what sort of bank financing and how much? So the credit is very, very important. The collateral is very, very important. But the most important thing is the character, the last C. And that's the C that most people kind of like overlook,
right.
right? How much experience does my operating partner have? What does he bring to the table? What kind of a character he is? That's a lot of those things. You really can't put them into an Excel, right? You sit down with an individual and you have a conversation and you see that, the experience is there and they've done similar deals, which
Mm,
is what we look for. I don't ever want to do a deal with somebody's first time in the market, doing a first time asset, and trying to figure it out with me. I'm not looking for that, right? I always say my partners manage the day to day. I manage the month to month.
Mm.
So, with all the experience, but how do we mesh as personalities? Where's the integrity? Is it going to be somebody I'm going to have comfortable, I'm going to have fun working with for the next 3 to 4 years? Or it's going to be miserable?
Mm.
We're very demanding from our partners, right? We want to see reports and we do inspections. We take trust by verify to a scientific level. We're custodians of capital,
Right.
right? So we have to. So we want the report and we want to know if there's issues or if they're facing issues well ahead of time. And that's may not seem like a lot of fun, but essentially, when the end results is that things work, then we tend to do more deals together. And then
Got it.
there's friendship that gets to build over time and things like that. So I'm always excited about the real estate deals that I do. I always have concerns and fears. And I always say the day that I lose my concern about a deal, that's the day I should probably take a break and, do something different. It's what keeps us on our toes.
Got it.
Yeah.
Okay. And can you walk us through a deal that you did recently that kind of exceeded your expectations?
Sure. Well, we bought, it wasn't a typical deal, but we bought this complex in Tampa, South Tampa. Nothing, very unassuming complex of apartments. I think it was 12 buildings, a combination. And I was very, I was okay with the asset because I knew it's going to generate some cash flow and we'll be able to slowly improve. We typically don't buy existing. Most of what we do is build. Well, we have a little bit of value adds when we find the right deal. And so we bought it in 2019, very, very late 2019, November. And we all know what happened 4 months later, 5 months later, the world comes down to an end. I remember driving down from Miami to Tampa, and it felt like, Mad Max movie. There was no
Right.
cars. You're alone in the 95 and nothing, and then all
Yeah.
of a sudden a truck goes by you. So look at each other, it's like, are the humans here still? It was very, very surreal. My wife and I would be driving, and I remember my office managers and stuff like that. Some of them, they were scared to go to work. It was so much information out there.
Mm.
Nobody knew. And so we went through the pandemic slowly. Early 2021, I started feeling that the market is shifting. There's something going on around the multifamily space, certainly around Tampa, which is today, by the way, the top market in the United
Yeah.
States, top from the 25 in terms of rent growth and so on. And so, I started kind of like poking around as to where bids are coming. I get a phone call from one of my friends. He's like, "Hey, Joe, I heard you guys bought this deal in Tampa. Would you be willing to sell it?" Now, I'm always a very curious guy. It's like, well, for the right offer, right? It's kind of like a knee-jerk reaction. Sure, for the right seller, for the right price. We're always sellers. And I provided him the numbers. We've anticipated to sell at a certain price point by the end of year 3.
Mm.
The offer came back, and the price point was that. And it was like maybe a year and a half.
Wow.
It's like, wow, we got something there. So I called one of the local brokers and I started poking around. What's going on with the market? What are you seeing? He says, I think I'm seeing a lot of activity. There's a lot of folks out there, a lot of Northeasterners, New Yorkers, Bostonians. Everyone's running around looking for assets,
Right.
making bids. It's like, I want you to come down and I want you to evaluate our asset. And the end result is we approached 2 or 3 different shops. We ended up going with one. We've gotten, I think, close to 40 site visits, 23 proposals. We were able to outperform, let me just say this, my return after our promotes and fees and all that good stuff, our return to our investors was a 43%.
Oh, wow.
On an annualized basis.
That's awesome.
43%. It's not something that we did. All we did was held tight,
Right.
All we did was make sure that the property is good. It was just the market. What we did, though, is we recognized that this is an anomaly. And when people are crazy like that, go ahead and be a seller. And so throughout 2021, we were net sellers. And the deals that we've done is obviously deals that would end up being brought to the market years later because a lot of them are ground up construction. So I think that was a unique deal. It wasn't the only one. We outperform in a number of other ones. We've had some that were a little bit disappointing. Thank God, 28 years, never lost a dollar to an investor though.
Great. Awesome.
Yeah.
And I want to know how you prepared your company for institutional capital. Are there some changes or things that you had to implement in order for that to happen?
So I think what's important to institutional capital is to see, first of all, your portfolio and what sort of asset you go after. In our portfolio, you can find 1 million square feet asset. You can find some pretty good stuff. We aim for assets that are sort of like geared to institutions by size. Most of what we'll build, if we're building a multifamily, it's going to be a little bit over 300 units. And so, it's above the mom and pops. It's a little bit above the family offices and stuff like that. So it's more like geared towards the institutions.
Got it.
We pick the locations that are considered top locations in terms of which MSAs we follow and what's the reason we follow and job growth and so on. Internally, our reporting system and the way that we do our asset management makes a very big difference. So most institutions, typically what you'll find if you'll open up the kimono, you're going to have billions of dollars under management in the hands of 3-4 guys, and they're inundated, right? They rely on guys like us to come in where they can get, kind of like true to the fact, what's happening on the ground, picking up the right asset, negotiating the right deals, and producing the right results. And so it has to kind of like, as opposed to like, because I have a lot of high net worth that invest with us. We have over 250 high net worth that invest with us on a consistent basis. My wife and I, our capital goes into every deal, which is also important to the institutions. They do want to see that there's some skin in the game. So we bring skin in the game. We bring, years of experience. We bring, quite a strong portfolio, quite, I would say, impressive portfolio, right? If we do hotels, we have 2 hotels right now in our portfolio. They're both 5-star hotels, 4 or 5-star hotels. One is the SLS, the other one is Caesars. It's not like you're kind of like, Motel 6 on the side of the road. It's very different. Nothing wrong with Motel 6 for those who are owning Motel 6. I love them. I pass by them. Nothing wrong with those as well. I know they're moneymakers. But, the quality of partners that we choose, they're vertically integrated. These are groups that, for the most part, our average partner has usually second generation, vertically integrated with construction administration, construction management. If we're buying value add, it comes in with an in-place management, not like a third party. And when we do that, we kind of like have to pay the price. We have to do a lot of the work ourselves. That's a story for a different day. I think those are the major things.
Got it. Okay. And what value add strategies do you employ that may be seen as out of the box or unconventional?
Value add strategies. I like graffiti since I'm a young kid. So not only when we take over, and again, we don't do that a lot, but when we take over an asset on a value add, we do something, we add a little bit something extra. So you might see murals that kind of like brings the community together in our buildings. You might see like a bunch of complexes, and then you'll see a complex looks a little bit different. So there's some attention to details. It's like my partner from Israel, Ron, likes to say, E+1. It's what you expect plus and then some, right? Plus the +1 is, I think, where we make it a little bit different. But other than that, I mean, value add is fairly simple. You come in, you change the kitchens, you change a little bit the kind of like the makeup of the space. We pay attention to common areas. I think they're very important. I want people to feel comfortable where they walk around, and so that's important to us. But that's essentially it. It's a fairly simple business.
Got it. Yeah. And can you walk us through a deal that you were very confident in, that you thought was going to be a layup, and it ended up not going like you thought it would?
Yes. We got into a contract actually to buy equity position from a very, very large family office. I'll skip the name, but you have their computer in front of you. Probably 40% of the United States have their computers in their homes. So we bought a piece of equity from this development on the Upper West Side. Um, it's a beautiful deal, decent spot, and I think I a little bit overlooked the fact that the market for those condos, above $4 million is very shallow.
Mm.
And so, I think that with the sheer size of each one of those units, the quality of finishes, I think we're moving slower than expected. And so I think in my portfolio, that will be probably the lowest return I'll provide to my investors. I expect it to be very low double digit annualized or maybe high single digit, where in reality, if we were being able to come out of this deal in around 3 years instead of 4, I think we would have been kind of like upper double digits,
Okay.
upper teens. I'm sorry, So that was a little bit of a disappointment, and but I think that was pretty much the deal that kind of like reduced our overall.
Right.
We're at 23%, considering all things that we've passed in the last 3 years. 23% on fund average, in my opinion,
Still very high.
is very, very high.
Yeah.
It's certainly above most. That's the one that dragged us
Got
down.
it.
We're underwriting it today is I think 7-8% per year, and we hope to do a little bit better. But yeah, that's the one that didn't quite, in my opinion, pencil like we wanted to.
Got it. Understood. And I want to ask for your perspective on the office asset class.
Mm-hmm.
Are you seeing any interesting ideas for repositioning office buildings, maybe Class C or Class B office buildings?
Well, repurposing offices, I think it's a must,
Mhm.
right? And there's tremendous amount of pain, but the pain is not all over, right? I mean, you'll see the pain concentrated around certain cities, and interestingly enough, those cities are almost been asking for it in many ways. It's not easy to say, but where's most of the pain, right? Chicago, San Francisco,
New York.
Los Angeles, New York. Well, you got to ask yourself what's going on. But people are kind of like, I'm not coming back to the
Right.
office in those places. I'm not coming back because the streets in those places have gotten different. Things have changed. So what has changed, right? So we can go back a little bit and talk political and decisions
Right.
that the local politicians and local community boards have been making, and that's sort of like the root cause for
Right.
most part why you're seeing it affecting the street, because you let the street go.
Yeah.
Right. And so yeah, but there's a lot of pain in office, and we're seeing the best of the best. We're seeing Silverstein Properties returning back the keys, wiping out $30-40 million.
Yeah.
We're seeing Blackstone. We're seeing Brookfield. There's no end. It's really a very severe situation. And what we're seeing today is what we saw 15 years ago, and in the space of retail, right? There's just been too much of it. There's been a shift. The next generation doesn't view retail as our parents' generations did. This generation doesn't view working from the office as our parents did, right? Just go down to Starbucks. How many people are sitting there on their laptops?
Computer, yeah.
They're working.
Yeah.
$50-$60 an hour. This is what you're seeing, all of them. And so nobody picked up on it. Now, quality of life, shift in generational perception, and now you have it, right? There you have it.
Right.
Now, again, I'll take you down to Miami. We'll go down to Brickell. I'll show you $200 per square foot, and you can't find space. I'll show you $150 per square foot, and you can't find space. The new offices that's getting built out there, right? So it's a tale of two cities, right? It's completely a tale of two cities. In Miami and South Florida and Boca and West Palm, you can't find an office. In New York, you can't give it away.
Yeah.
In Los Angeles, you can't give it away, right? Now, why is that? You come down to the streets in Miami and in locations that are in demand, and the streets are inviting, right? The vibe is different. The quality of life is different. You come out of the subway in certain spots in Manhattan, and it's like you want to come back again, and you want to maybe I should take an Uber.
Right.
it's painful to say. This is the city. I love the city.
Yeah.
There's nothing more I love than this city. But I've seen how decisions are made. I was an advisor for the state of New York, not the city, for 9 years.
Mm-hmm.
I was nominated by David Patterson, Governor David Patterson, to sit on the board for 2 years.
Right.
There's a federally mandated board. There are 13 of us, 5 real estate professionals with good standing. The rest are politicians, Secretary of States, and so on. So sort of like, seen it firsthand, how decisions are being made, and it's painful. It's painful to see. But if you see it long enough, then you're starting to recognize patterns. And this is why it's important, I think, for everyone. I don't take political risk. Don't do it.
Right.
I'll take market risk. I'll take performance risk. I'll take the risk of inflation going up and down. I'll manage those, right? I don't take political risk because political risk has almost nothing to do with business. The decisions are many times in oppositions with what the business environment needs. I predicted this issue years ago. In fact, it's on video.
Right.
If you'll see one of my, I put together the master's class, real estate master class. And one of the master classes is mine. And I predicted this video several years ago that we're heading into an issue. It's going to be a very severe issue around office. It's going to be even more severe because the city is going to be cash strapped. And while the office landlords are sitting there sucking wind because they're like 50, 60%
Right.
occupied, the city is going to push more and more on taxes. It's going to be extremely tough. There's going to be a bloodbath that's coming. It's just a matter of time.
Right.
A week later, I get a phone call from one of my partners. Hey, we're about to buy an office. I was like, click. Not interested.
Got it.
Not here. So in our portfolio, we have about 140,000 square feet of office. Mainly it's in Miami. Mainly it's geared towards medical, cutting edge medical. Large company from California that came in, beautiful. So, but I don't want to have traditional office, right? We're not, just by personality. That's not our thing.
Got it. Okay. And what do you think needs to happen politically in a place like New York so that the problem can be fixed or mitigated for Class B or C office buildings?
Ethan Panner once told me, look, it's a pendulum, right? It's a pendulum swinging when you look at politics,
Right.
Joe. And he was so right. He goes, once you push the pendulum too much to any direction, left or right, it will eventually have to swing back. And so that's exactly what we're seeing. We've seen a shift. We've had years of Giuliani. We've had 12 years of Bloomberg, right? We have 20 good years. The landlord, the business guys, Wall Street, everyone was making money hand over fist. And so the pendulum was swung one direction. Blue collar, folks that were left behind.
Right.
Kind of like, by a good amount of 20 years have seen that, how the other half lives. And I think the pendulum is now swung back, and it's swung back so severe and so, so strong that eventually it's going to have to. It's going to have to swing back more towards normalcy, more towards a balance. And it will, because it's been pushed too far. And I think we've had a horrendous mayor after Bloomberg. I think we had a horrendous mayor, and it's us to blame, us New Yorkers. And the reason it's us to blame is because we never bothered to go out and vote. We never bothered. We we had it too good, right? I never complained as a property owner in New York City and a building owner in New York City. I never complained that my real estate tax during Bloomberg doubled.
Right.
So I was making money. I was able to increase rents. I was happy. I was paying tax. Everyone was good, right? Now, with the way things are running, it's kind of like hard to explain why the city sucks so much, taxes so much, and yet the services are subpar. So that's where I think we have to watch out for.
Okay.
But political risk, we do the best that we can to stay away from.
Got it. Okay. And so besides these types of office investments, what investments are you kind of staying away from or shying away from?
Not a big fan of senior housing.
Okay.
Not a big fan, just because it comes with services.
Okay.
And I cannot really control it. My fear is, headline risk and things like that. Now, it's an important sector. I can't control my operating partner nurse not doing something that she
Right.
shouldn't to one of the residents. I don't want to be there. I don't want to control it. I can't control it,
Mm.
right? So I'll stay away from that sector. It's an important sector, and some are great operators when it comes down to it. But we never focused on it. It's not our thing. I mentioned obviously office. In terms of hotels, when I do choose a hotel, it has to be exceptional.
Mm.
It really has to be exceptional. Location, the stars have to be fully aligned. I have to have an amazing operating partner, one with depth of experience. I have to have an amazing concept of a hotel. I'm not interested in just another, as I said, another brand on the
Most
side of the
definitely.
highway. That's not the kind of stuff we do. So those tend to do better during economic cycles.
Got it.
And so I think, I'll say a lot of no's to hotels, but I'll say yes for the right ones.
Okay.
Um, other sectors, I'm a believer in stay in your lane. I haven't pulled the trigger yet on anything to do with life science
Okay.
centers. I think it's kind of like a lot of good guys out there looking for it because it's kind of like the flavor of the month. I'm not quite sure that they're bringing the type of experience that
Got it.
that they should be. Um, and essentially, that's it. We're pretty much agnostic, asset class
Okay.
agnostic, but we do have preferences.
Let's say somebody watching this right now just graduated college and wants to be an investment manager. Would you recommend for them to work at a big shop like CBRE or JLL for a couple years, or just jump into the business right away?
From my experience, walking in the trenches of brokerage gives you a tremendous perspective, amazing perspective. Who knows all the players? It's the brokers,
Right.
right? And think about it. Who knows all the players? It's your job to know everybody.
Yeah.
It's your job to sit in front of them to make sure that they know you, right? There's a saying, it's not who you know, it's actually who knows you.
Yeah.
It's your job to know that it's your job for them to know you. It gives you a kind of like I started as a shower, right? 1995, like 28 years ago. Started as a shower. It's like starting from the mailroom. That's
Right.
in our industry. That's the mailroom.
Yeah.
Um, and certainly starting at a JLL or CBRE or any, even a boutique brokerage shop that focuses on those type of assets. You start from kind of like understanding the thinking of
Mm.
buyers, of
Mm.
sellers, of lenders, of banks, of finance. It's extremely, extremely valuable experience. It's tough, especially in New York. It's tough, and you got to work your way through. And they may not be your career, right?
Mm.
But it will certainly give you a great perspective. So if you can intern at a brokerage shop, like a good one, right? You can intern in a brokerage shop, do it. If you can get yourself a junior position, do it, right? It's a wonderful learning
Right.
experience. It cuts through a lot of stuff. You start at, just going to say it, you start at Goldman, right? It's going to be years and years and years of kind of like being closed into your little
Yeah.
cubicle or things like that. You don't really get the exposure. You're not going to get to pitch to, SL Green about your new asset. You're not going to be part of it. You may not be the one pitching, but there's a very high likelihood you'll be in the room
Part of
observing
the
how
team.
it's done,
Mhm.
seeing what's going on. You'll be working on the investment memo until 12 o'clock at night because
Right.
you know the deadline is tomorrow and you need to print it out.
Right.
You'll get the essence of those things, and it's not something you can buy. Or it's invaluable. It's amazing.
Got it. Okay.
Yeah.
And let's say somebody works as a broker for 3 to 4 years, and now they want to become an investment manager.
Mm-hmm.
How can they start raising capital with no previous track record?
Well, we got to approach the low hanging trees, right? Those who know you, those who trust you, essentially friends and family,
Okay.
right? That's where the club of friends and family it comes through. Right? Approach your dad if he has it. Approach your uncle.
Right.
Approach your neighbor. They know you. They trust you. It's not simple, right? It takes a while, but
Right.
you start small, and as long as you're persistent, and as long as you're put your nose down and kind of like keep on doing the good work, eventually it will pay off.
Got it.
Um, it took me many, many years to make the shift from an advisory to a manager of capital to private equity. And I felt that that was my journey. I
Mm,
had to do it when I was like fully confirmed that I can manage that capital. It's a custodian of that capital. It's a great responsibility. It's
yeah.
an awesome responsibility. Um, so that's my journey. Doesn't mean that, you need to go and wait for 20 years until you can actually go out and do it. Certainly jumping in and working at a private equity shop will certainly help.
Right.
Those are very good, valuable lessons, that a young person can take.
Right.
Learning how others are doing it, learning from what works, what doesn't work, is extremely important.
Got it. Okay.
Yeah.
Understood. And I want to understand how you kind of set goals for yourself and for your company. How do you go about this process?
Oh, I always reinvent things. Our next chapter is credit fund.
Okay.
I always reinvent things. And so, we spend a lot of time together. Um, we look to see where we're valued, what value we bring. We look at the market and what areas and where capital is shifting and flowing.
Right.
We always observe where capital is being extracted from, what's getting dried out of capital. So we always start with that, right? The currencies, and where everything is moving. And then we look for dislocations. Right now, we have a tremendous dislocation, again, as natural, within the capital markets, right? The banks
Right.
are pulling back. 57% of lenders saying that they're toughened underwriting, they're constructing, and the amounts, and we're seeing it. So developers who are out there, those who are actually willing to go out and construct and build or buy, find it very tough to deal with banks. Enter the era of higher interest rates by the secondary market. And so, our goal in the next 6 months is to launch our credit fund. We lined up a very large line of credit from an institutional group. And we're soon going to be embarking on coming out to the market.
Awesome.
And doing our initial roadshow to raise a certain amount of capital. We're going to aim for about $200 million.
Okay.
And start offering a lot more debt product. And the reason being, it's because that's what the market is lacking right now. So when I shifted from brokerage to private equity, I recognized that the market is in serious lack of equity. Right? There's always a lack of equity, and that will never change. Right? Sometimes, obviously, there's a lot of dry powder, and there's like a lot of money, and we feel it. Right? Our offers getting denied. We have to squeeze our returns. There's always going to be that kind of like, there's always going to be a need of equity. But right now, I'm able to generate returns on debt, right? A first position debt, bifurcated first position debts to my investors that are just as good as equity.
Right.
So why take the risk?
Okay.
Right? So that's where it is.
Okay. What would you say makes a good leader and a good principal? What are the ingredients to that?
Well, what makes a good leader and a good principal is, I believe, if you can get your team to buy into your goals and your ambition, then you are also responsible to find out what's their goal and their ambition. So my goal is, for example, in the next 5 years, to add this other piece of business and to grow Astor. Right now we're managing around $2.25 billion in assets. But really, equity is around $140 million, right? So my job is to grow it, to grow it exponentially. And so that's my goal. That's my ambition, and we're going to do it. And we're doing it. My job is also to find out what's the goal of my analyst. What's his aspiration? Is his aspiration to stay with me and show up at the Zoom call at 9 o'clock in the morning, or is that like, what's his 5-year goal? And if I learn about it as a good leader of a company, and my job is to help him get there. And if I do that, we're aligned.
Got it.
Then he has me and I have him. He's got my back. I have his.
Got it.
And it's very different than, okay, my company's going to be, and the company's going to be, and we're going to be, and root for the company because the company's going to do. Well, what about the makeup of the company? The
Got it.
makeup is only the company. The company is only good as the folks that are there, that
Got
are
it.
showing up, that are committed. So there has to be that give and take, and a lot of people forget that.
Got it.
They put lofty goals. This is where we're going to be. Well, with whom exactly?
Got it.
This is why we have people stay with us for many, many years. We almost have no turnover.
Awesome. Great. So would you say your approach is less about directing people what to do and more about bringing everyone up together and encouraging everyone to be a free thinker as well?
It's very good way of saying it.
Perfect. Great.
I think you're starting to develop the skills necessary.
And how would you recognize an opportunity that you want to go big on? Is it based on intuition or is it based on facts?
It's a combination of everything, right?
Mm.
So you really want to listen to yourself and listen to your gut, right? But the question comes from facts, right? The question comes from, well, what's missing? Well,
Right.
let me look, right? So start looking. So start doing the research and then conclusions and then insights,
Mm.
right? So it's always this process. Sometimes it's a short process. You can do it during the shower, and sometimes it's a lengthy process
Right.
during conversations, many conversations with with Semzel, and conversation with Ethan Penner and all the other folks that I work with, and the conversation with Adam Coffey, conversations with my wife. My
Mm.
wife is one of the smartest persons I know. I call her my wisdom tree.
Awesome.
Whenever I'm stuck somewhere, I go back to her and we have a conversation. She's extremely intuitive, very, very pleasant to speak to and speak with. And she always have a different angle and a different approach than what I'm accustomed to, right? And it never comes from just pure business.
Mm.
It comes from very different areas. So listen. Consequently, if you ask me what's my superpower, I'll tell you it's listening.
Okay.
Listening, intuitively listening. And so eventually collecting all of this stuff, taking the time to think about it, and then eventually your intuition will play a big role. If you
Mm.
choose not to listen to it, you're missing a very, very important element
Part of it.
of
Okay.
decision making.
Got it. What drives you nowadays? Is it money, personal achievement, family, philanthropy? When would you say you're kind of ready to retire?
Well, what drives me? I love what I do. I'm extremely passionate about what I do. And retirement, it's not in the
Not
cards.
happening? Okay.
Not happening. Not happening. Money drives me, yeah, to an extent. It's a byproduct though, right? When you do well and you love what you do, money's there.
Right.
Larger transaction, does it come with more money? Of course. Everything is kind of like combined. Money's good. The passion that we have for the deal is good. The winning aspect is
Mm.
good, right? The winning aspect is good. And a lot of transactions we have competitions on.
Mm.
We're not the only check that wants to show up to the table, and we have demand. We're very, very demanding. We don't compromise on those things. So it's a combination of winning the deal. It's a combination of seeing the check. It's a combination of seeing my office happy and kind of like, go team.
Awesome.
It's all those things combined. I'm not. I have to be in the doing.
Mm.
I have to be in the doing. So my wife and I would go on vacation. It's like 3 days into it, we're already like talking about real
Business
estate and what would it look like to build here.
Right.
And I wonder whose land is that, and that sort of a thing. It's just who we are,
Got it.
right? It's not separate from us. It's not like a 9 to 5.
Mm-hmm.
It's our DNA.
Got it. 24/7. Got it. And Joe, I have my final question to wrap this up.
Sure.
What advice would you give to your 23-year-old self?
The advice I would give my 23-year-old self is go out there. Don't mind what they say.
Mm.
Go out there and do it. Focus less on what they say. Focus more on what you want, what makes you happy. I am a very easy person to be around. And sometimes at a young age, a little bit too many compromises.
Mm.
Look to see what makes you happy. And, stay on the focus. Keep on staying on focus because, it's a wonderful journey. And by the way, my journey is, I'm 51 years old. My journey is,
Ongoing.
ongoing. I mean, I'm kind of like scraping the surface. We haven't seen nothing yet.
Got it. Understood. Well, great. Thank you, Joe. I really appreciate it.
Thank you.